When you think of American power, you likely picture aircraft carriers or stealth bombers. But the United States also manages the underlying infrastructure of the global economy. To understand this, look at how international trade functions. Whether a country is buying oil or a corporation is settling a billion-dollar invoice, those transactions almost always use US dollars and route through American banking systems. This setup gives the US government a clear view of global commerce. Inside the Treasury Department, the Office of Foreign Assets Control, or OFAC, acts as the regulator for this entire network. If OFAC decides a foreign entity is acting against American interests, it can issue a unilateral sanction. This effectively severs that target from the dollar. No international bank will risk processing their payments, leaving them isolated from the world market. Historically, the mere threat of this isolation was enough to force compliance. The prospect of being locked out of the global economy kept nations in line without a single shot being fired. That dynamic held until the U.S. targeted a specific group of businesses in eastern China. These are privately owned independent oil facilities, known as teapot refineries. The teapots were purchasing heavily discounted Iranian crude oil, refining it into commercial fuel, and selling it to domestic markets. OFAC responded by designating these specific private refineries for sanctions. The aggressive move was designed to freeze their dollar transactions, block their property, and completely shut down their operations. In previous years, when Washington issued these orders, targeted nations would typically issue a formal complaint, while quietly forcing their companies to comply or hide the trade to avoid American retaliation. This pattern of quiet compliance was the foundation of American financial leverage. But the teapot refineries triggered a response that broke the historical precedent. Beijing chose not to hide the trade or look for secret workarounds. Instead, they took the conflict directly into the public sphere. The Chinese Ministry of Commerce issued a formal directive to its domestic companies. The instruction was explicit: ignore the American sanctions and continue processing Iranian oil as usual. This was an official state-level rejection of American legal authority over international commerce. It signaled that China no longer recognized the legitimacy of U.S. financial restrictions within its borders. Sanctions work by creating a risk that outweighs any potential profit. By ordering companies to disregard U.S. law in favor of local mandates, Beijing stripped the risk of isolation away. The message was clear: the threat of being cut off from the dollar would no longer dictate how Chinese businesses operated. But declarations don't solve the problem of frozen bank accounts. If a private refinery is cut off from the global financial system, it still faces the reality of potential bankruptcy. To prevent this, the Chinese government implemented a legal shield. If a refinery loses a contract or has payments seized because of U.S. pressure, the Chinese state provides direct financial reimbursement. The government effectively steps in to cover every dollar lost to American enforcement. This guarantee allows these private companies to trade freely. The financial risk of crossing the U.S. Treasury has been transferred from the individual business to the Chinese state. By replacing corporate vulnerability with state backing, China has made U.S. economic pressure a secondary concern for these businesses. Beijing's decision to execute this defiant playbook now is a result of calculated observation. China has watched the U.S. face increasing friction in the Middle East and heavy resistance to its policy goals on the world stage. They see a window where American enforcement is stretched thin. This defiance limits the leverage of the incoming American administration. It signals that future negotiations cannot rely on the traditional threat of economic penalties. Successfully pushing back against financial decrees allows the current Chinese leadership to project a new level of global authority. This ability to shield an entire economy from the dollar is a prerequisite for more direct confrontations. If Beijing can prove that sanctions will not collapse its domestic industry, the economic deterrent against a move on Taiwan is significantly weakened. The refinery dispute is the proof of concept. It demonstrates that China can maintain its critical supply chains even under a maximum pressure campaign from Washington. The world is watching this development closely. Massive networks of international commerce are seeing the first successful blueprint for bypassing American financial control. China has provided evidence that a nation can survive operating outside the U.S. dollar-based order. Emerging economies that have felt the pressure of unilateral U.S. sanctions now have a clear model for defiance. This marks the shift from a single American-led financial system to a multipolar economy. The world is splitting into two distinct ecosystems that can operate independently of one another. By protecting these local refineries, China has demonstrated that the risk of being cut off from the dollar can be managed by the state. The threat of financial isolation is losing its power to dictate the behavior of global powers.